In this video, I will provide a summary of the book Trading in the Zone written by Mark Douglas. Mark Douglas was an American author and trading psychologist who specialized in the psychological aspects of trading. His approach to trading psychology has been influential within the trading community, and many traders have applied his ideas to enhance their performance. The content of this video is introduction, objective evaluation, pattern identification, responsibility for decisions, learning from wins and losses, consistency and adaptation, documentation, and conclusion. Introduction. The book Trading in the Zone delves into the psychological aspects of trading and has significantly influenced traders worldwide. In this presentation, I will explore key concepts such as objective evaluation, the impact of emotions, learning from mistakes, and the importance of responsibility in trading. Join me as we uncover valuable strategies for identifying and managing trading patterns, learning from both wins and losses, and achieving consistency and adaptability in the dynamic world of trading. Objective evaluation. Impact of emotions. Mark Douglas discusses how emotions like fear and greed can influence trading behavior and one's self-perception as a trader. If self-worth is attached to each individual trade, it can result in overreaction and emotional swings that affect decisions making in future trades. Learning from mistakes. Douglas encourages traders to view losses as learning experiences rather than failures. By being objective and analyzing why a trade ended in a loss, valuable insights can be gained to avoid repeating mistakes. This approach helps separate personal worth from individual results. Consistent trading plan. An objective approach also involves maintaining a consistent trading plan regardless of individual trading results. Traders should trust their trading strategy and understand that random fluctuations are part of the trading process. Individual events should not shake confidence in the long-term strategy. Responsibility and freedom. Douglas talks about taking full responsibility for one's action as a path to freedom. When traders stop trying their self-worth to individual results, they can develop a freedom that comes from being accountable for their own decisions. This also allows for exploring new approaches and adjustments without fear of failure. Pattern identification. Impulsive reactions. Douglas points out that impulsive reactions are common among traders, especially when the market develops unacceptably. Identifying such patterns requires being aware of one's reaction in the moment. Traders are encouraged to recognize situations where they trade impulsively, and then reflect on the reasons for this impulsivity. Understanding what triggers impulsive actions allows for implementing strategies to handle these emotions better. Overtrading. Overtrading or taking too many trades in a short period can be destructive to a trading account. Douglas notes that overtrading is often a pattern linked to emotions like boredom, fear of missing opportunities, or the desire to recover losses. By carefully monitoring trade frequency and identifying periods of overtrading, traders can develop discipline to avoid unnecessary trades and maintain a balanced approach. Lack of patience. Patience is a virtue in trading, and Douglas emphasizes the importance of identifying patterns of impatience. This may include entering a trade too early, exiting a trade before it has had time to develop, or frequently changing trading strategies due to short-term results. By understanding the roots of impatience, traders can develop strategies to improve patience and stick to the plan. reflection, and self-awareness. A central part of identifying patterns is the ability to reflect and be self-aware. Traders are encouraged to regularly evaluate their own mindset and behavior during trading. This can be done through journaling, where thoughts, emotions, and decisions made before, during, and after each trade are recorded. Being aware of patterns makes it easier to implement changes and improvements over time. Reinforcement of positive habits. Identifying patterns gives traders the opportunity to reinforce positive habits and behaviors that lead to success. This may include celebrating successful implementations of the trading plan, maintaining discipline, and rewarding patience. Actively reinforcing good habits allows traders to gradually shape their behavior to align more with their long-term goals. Responsibility for decisions. Individual accountability. Douglas emphasizes that traders must realize there are individual entities operating in the market. While many external factors influence the market, it is the individual trader's responsibility to develop and follow their own trading strategy. Understanding uncertainty. He argues that the market is a place of uncertainty, and it is impossible to predict the outcome of a single trade with certainty. Therefore, it is crucial to accept this uncertainty and be prepared for both gains and losses. Consequences of decisions. Douglas highlights that traders must be aware of the consequences of each decision they make. Whether a trade results in a profit or loss, it is necessary to understand why it happened and how it affects the long-term trading strategy. Learning from losses. The book emphasizes that losses are an inevitable part of trading, instead of avoiding or blaming external factors. Douglas encourages traders to see losses as learning opportunities. Understanding the reasons behind a loss provides valuable insight that can be used to improve future decision making. Psychological responsibility. A crucial part of responsibility in trading, according to the book, is being psychologically responsible. This means being aware of one's own emotions, reactions, and mental state during trading. Traders must be able to handle the pressure and emotions that come with uncertain market conditions. Implementation of the trading plan. Mark Douglas emphasizes the importance of developing a solid trading plan and being consistent in its implementation. By following a predetermined strategy, traders take responsibility for sticking to a disciplined approach regardless of market fluctuations. Learning from wins and losses. Analyzing successful trades. Douglas underscores that it's not enough to simply celebrate success. Traders should carefully analyze successful trades to understand why they were successful. This includes looking at factors that contributed to success, such as accurate technical analysis, good risk management, or patience. Identifying success factors allows traders to try to replicate them in future trades. Understanding losing trades. Similarly, it is crucial to carefully examine losing trades. Why did the trade go wrong? Was there a violation of the trading plan, poor risk management, or an unforeseen market change? Douglas encourages digging deep to understand the underlying causes of losses. This provides insight into any flaws in the approach that can be corrected to prevent repetition. Eliminating randomness. A key mindset Douglas promotes is understanding the difference between random winners and losers and those that results from an edge in the trading strategy. He encourages traders to look for patterns and consistency in success, and not attribute every win or loss to luck or bad luck. This helps traders distinguish between random events and the real impact of their trading decisions. Developing a trading plan. Through the analysis of both successful and unsuccessful unsuccessful trades, Douglas emphasizes the importance of developing and improving a solid trading plan. This is a plan that considers all aspects of trading, including entry points, exit points, risk management, and psychological factors. Having a clearly defined trading plan can reduce impulsivity and provide a structured approach. Emotional control. The analysis of trades in the book is also linked to emotional control. Douglas discusses how emotions can affect the decision-making process and outcomes. By learning from both positive and negative situations, traders can develop better emotional intelligence and better handle stress and pressure during trading. Consistency and adaptation. Consistency. Consistency refers to the ability to execute the trading strategy and trading plan reliable over time. Douglas argues that traders should develop a consistent mental state and disciplined behavior regardless of the market's condition or individual trading results. Maintaining consistency helps build reliable trading habits and reduces impulsive decisions. Consistency also includes adhering to risk management rules, for example, sticking to a specific risk percentage per trade or consistently setting stop loss or take profit. This helps protect trading capital and reduce the risk of significant losses. Adaptation. While consistency is important, Douglas acknowledges that the market is dynamic, and traders must be willing to adapt to changing conditions. This includes changing in volatility, trends, and general market conditions. Being too rigid and unwilling to adapt can lead to losses in a shifting market. Douglas encourages traders to be aware of the current state of the market and adjust their trading strategy accordingly. This doesn't mean changing the strategy for every minor fluctuation, but rather being able to recognize long-term changes and adapt accordingly. Adaptation also includes the ability to learn from experience. If a trading strategy doesn't yield the accepted results over time, it's essential to be open to adjustments based on observations and insights from the market. Documentation, alertness and self-awareness. By carefully documenting decision-making processes and emotions in a trading journal, Douglas encourages traders to develop a high level of alertness and self-awareness. This allows traders to recognize patterns in their own behavior, identify potential mistakes and strengths, and ultimately improve their trading psychology. Analysis of decision-making processes. Traders are encouraged to try to recognize the reasoning behind each trading decision. This includes an analysis of technical and fundamental factors influencing the decision, as well as any psychological factors like fear or greed. Looking back on these decision-making processes allows traders to evaluate the thoughts behind their actions and improve their decision-making foundation. Emotional response. Documentation of emotional reactions is a central part of the trading journal. Traders are urged to try to recognize emotions that arise before, during, and after a trade. This helps them identify patterns of emotional stress, joy, or fear associated with specific types of trades or market conditions. Being aware of these emotions gives traders the opportunity to handle them better in future situations. Learning from experience. By reviewing past trades, traders can learn from their experiences. Douglas emphasizes that the form of reflection and learning is a continuous process. Through looking back at previous trades, traders can see how they have evolved over time, identify patterns in their behavior, and adapt to become more effective traders. Objectivity and self-analysis. The book underscores the importance of being objective during the review of the trading journal. Traders must avoid self-deception and carefully evaluate the results of each trade. This requires honest self-analysis and acknowledgement of personal strengths and weaknesses. Conclusion. In conclusion, Trading in the Zone by Mark Douglas offers a comprehensive guide to mastering the psychological aspects of trading. The book emphasizes the need for traders to detach their self-worth from individual trades, promoting an objective evaluation of their performance. Douglas explores the impact of emotions on trading behavior and advocates for learning from both successes and failures. By identifying and understanding patterns such as impulsive reactions, overtrading, and lack of patience, traders can develop self-awareness and implement positive changes. Taking responsibility for decisions and embracing the uncertainty of the market are essential components of successful trading. The book encourages traders to consistently follow a well-defined trading plan, while remaining adaptable to changing market conditions. Through thorough documentation and analysis, traders can enhance their alertness and self-awareness, learning from experience and continuously improving their decision-making processes. Overall, Trading in the Zone provides valuable insights into the psychological aspects of trading, guiding traders towards a disciplined and successful approach in the dynamic world of financial markets.